The reason I chose the fund vehicle, these are smaller assets. So if I were buying $100 million deals, syndications would be probably a better approach. You just raise around a particular deal, which is easier. It's harder to raise in a blind pool fund, which is what we sponsor. But we're buying deals, let's say from $5 to $20 million. They're smaller. Sometimes you got to move very quickly. The fund vehicle was a lot more intriguing to me. I wanted that autonomy, that ability to move quickly, to be creative. And this vehicle allows for that versus the syndication model.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Matt Ricciardella, thank you so much for being here. Founder and CEO, Crystal View Capital, 650 million plus assets under management, 101 billion plus total transaction experience, 20 years in real estate. It was really cool to hear your story of from New York, and you said that, how could I make money outside of college? What is the quickest way to, not only quickest, but the sure way to get there? And real estate was that path for you. Talk to us about how you actually found that it was real estate.
Yeah, it was an interesting path. Sometimes you have an intuition, you want to call it a gut feeling. It was one of those type of moments for me. So I didn't have any empirical evidence, if you will, that told me that. It was just, I knew I could get a real estate license pretty easily without a degree. And I saw people making a lot of money in that industry and thought, if they could do it, maybe I could do it. And I was right. And it took a lot of hard work, took a lot of energy, but it was very fulfilling, both economically and in my career. And I'm certainly glad that I chose that path.
I heard you talk about moving from New York to California and going that agent path, making hundreds of calls each day, and finally stumbling on one where you were like, hey, is your house for sale? You want to sell?
Yeah.
And they're like, well, why don't you buy the duplex? And that kind of kicked off your career. That's what a fun way to get posed that question and be like, oh, this is an opportunity, and following that, right?
I wish I could take credit for it, Steven, but it wasn't even my idea. It was the seller's idea, and I'm sure glad that he came up with it, and God bless him for it. But he worked with me and ended up buying that place and flipped it a couple of years later and did it extremely well, and it launched my entire career. From that point forward, I just thought, why would I go back to listing homes or working with buyers, doing that type of thing on a commission basis, if I could be an investor and build my own portfolio?
Yeah. I mean, the idea of it wasn't even your own idea, but I think it's kind of two things. It's spotting the opportunity and acting on it, right? And I do want to go back and kind of get your thoughts on, you were in college for a year and you dropped out to take this path and ultimately be successful into where you are now. But why drop out? I think that's a key consideration. Was it just like, this studying in school thing isn't for me, I can learn while doing, or was it something else?
Yeah, I was never a good student. I always struggled. Even if I was one of those, even if I tried, I don't know. I think I've always had AIDS. At that time, it wasn't diagnosed. A lot of people have said I have it now, so I guess I do. And I have a lot of those traits. I've learned how to harness that to my benefit.
Yeah.
But I remember it distinctly. I was sitting in a classroom and I was really wanting to get my career going, and I was passionate about it. And I was sitting there learning about American Indians, and nothing against American Indians, but I'm thinking to myself, I want to make a lot of money. I want to start a business. What does this have to do with any of it? And I remember I just got up. I walked out of the classroom and that was it. I just never went back. I went right to the office. I was already kind of starting as a realtor. It just felt right. A lot of this comes back to this gut instinct. I remember sitting in this seat making, like you said, hundreds of cold calls a day, and it was a grind, but something deep down said, this is where I'm supposed to be. And I just leaned into it and went after it with everything I had.
Yeah. I think, what would you call it? Would you call it intuition?
You could call it that. You could call it a hunch. You could call it destiny. Whatever you'd like to call it, I felt it.
Yeah, and acting on it. I just want to comment on this too. You said you're not a good student, but I think it's the way that you actually go about it, because you have talked about values that you and your team have now of think like an owner, about vertically integrating. We'll touch on that too, right? The philosophy of that you come up with to, and the team you're working with, all the way from how you acquire things, how you manage, how you operate. And all of this takes learning, including be able to serve investors like you do today, and having the fourth fund that you have with manufactured homes as well. And so this is all different learning, right? Like, and so I think it's just the way you go about it.
Well, I'll make a distinction, if I may. I think there's a real distinction between being a passionate and a lifelong learner and being very good at formal education.
Yes.
And I was not good at the latter, and I believe that I'm pretty good at the former. And I
Yeah.
love the learning process is intriguing. It's exciting. It's fun. I mean, one of my mentors always said, Charlie Munger, and I actually have this written on a coffee mug. He says, wake up the next day a little bit smarter than you were the day before. If
Love
you
it.
could do that's a successful day. And whatever that is for you. For me, it wasn't formal education, but I'm passionate about the investment process. I'm passionate about economics, serving my customers, my investors, going out there, finding great value in the marketplace, leading a team, inspiring a team, building systems and an infrastructure. Those things kind of light me up. And therefore, I love to spend time on them. I love to be the best at my craft, get better at it each day, read about it, study it, talk to others who are actively doing it. So it's a more interactive form of learning, and it pays a heck of a lot better than sitting in a classroom as well.
Yeah, most definitely. The specialized knowledge, specialized learning. And I would have to argue with you just a little bit, Matt, is that you are a wonderful student, but it's just the things that you're passionate about. So.
Yeah, they don't have a course on this at school. Not that I know of, because if they did, I would love to take it.
Yeah. So talk to us where you are right now. I talked about it a little bit, right? You started from doing the realtor thing to finding this duplex, acting on that idea, ultimately making a couple $100,000 off of that flip, doing some more. And then finally today, 4 funds later, one after the other, a little bit bigger. What are you investing in? What are you and your team do? Talk to us about that.
Yeah. So, this is our 4th fund, Steve. In our first fund, we've bought assets, we've sold them all off. In the business, we call that it's gone full cycle. And we actually were at one point ranked the number one small with assets of less than $50 million, the number one private equity real estate fund as rated by Preqin, which is a third-party rating agency. So we delivered a 45% IRR across that fund over a 6-year hold. So really great performance. And then we went off, we launched Fund 2. And this is a dual strategy. It's self-storage and manufactured housing communities. And in Fund 2, we were weighted about 60% manufactured housing communities, 40% storage. Fund 3 is the inverse, 60% storage, 40% MH. Now, Fund 4, we're weighted about 85% MHC and about 15% storage. And really all we're targeting moving forward in this vehicle is manufactured housing communities. And I think what makes us different, you and I were talking about this a little bit before we got started here, is our setup is we're vertically integrated. And what that means is we find all of the deals, all of the transactions and the new assets that we acquire, they're all sourced internally off market. So we're not really going out to the brokerage community. We're not participating with auctions. We have an in-house sales team. Those people are going out in the field. They're building relationships with mostly legacy owners, mom and pop owner operators, building a rapport, building that relationship. And we're buying those deals right, structuring a win-win deal between the seller and ourselves. And then once we acquire the actual property, we have an in-house property management / asset management team that basically steps in, and they're executing a strategy. We call it the value add strategy. And that could range. Each property is a little bit different. The end goal there is, how do we drive net operating income? Because that's going to drive valuation. It's going to drive our ability to make distributions to our limited partners. And that's what we're known for in the industry, is making outsized risk-adjusted returns. Right now, we're paying roughly an 8% return to preferred return to our investors in Fund 4. But across these vehicles, these are high teens, low 20 level IRRs great assets. They continue to grow. They continue to be in great demand. A lot of institutional capital is chasing both of these property types, and we're at the forefront of making deals happen and adding value to those deals.
Yeah, the building the relationships is key, right? Especially because of mom and pops. Feel free to expand on any part of this, but it takes some time to get these deals because mom and pops want to build that trust, right? And having that team build these relationships certainly is that differentiator. Based on, is there a range on how much time you've seen where a deal actually comes into fruition? Like 5, 6, 7 months, a year? Like, I know it ranges, but what insights can you give on that?
It's a great question. And you're absolutely right. It does range. If you think you're going to pick up the phone and call somebody and that day you're going to get a signed PSA, it ain't going to happen. I've seen it happen quickly. I've seen it happen in a couple weeks. I've also seen it take me 10 years plus and everything in between. I won't give up on the relationship. The key is we want to build the brand, the integrity, and the name where when the seller is ready to sell, whenever that time comes, and it's different for everybody, it could be an illness, a divorce, partnership dispute, estate planning, whatever it is, we want to be the first name that comes to their mind when that time comes. And the only way that's going to happen is you have to stay in front of them. When you're in that market, you take them out to lunch, you meet them at the park, you walk through it, you listen to their story, you build that trust and that rapport. Because for a lot of these people, their family put their blood, sweat, and tears into building these properties. Some of them are purely money motivated, and we're probably not going to win those deals. If an institutional capital provider comes in, a lot of them, think about Blackstone, Apollo, they're all in the space. Their return profile is so much lower than ours, we're not going to be able to compete. So in those instances, we're out. But in most instances, you'd be surprised. It's not who could strike the largest check. It's who's going to be the best steward for the asset. And that's the key. That's what we position Crystal View as for these particular owners. So when that time comes, we're not winning them all, but we're winning a lot of those deals. And we structure a win-win. A lot of these sellers, the other interesting thing, Steven, post-transaction, a lot of them turn around and invest with us. They get this windfall, and it's like, okay, now where do I go and put my money? I understand the property type. I built the rapport with this group. I'm just going to turn around and put my money right back in. And that's happened time and time again. And it just goes back to the brand, the trust, and what we do on a daily basis to win that trust.
Yeah. Did you end up skipping things like syndications and going directly into funds?
I did, but it's interesting. A lot of groups just do pure syndications. Nothing against that. The reason I chose the fund vehicle, and these are smaller assets. So if I were buying $100 million deals, syndications would be probably a better approach. You just raise around a particular deal, which is easier. It's harder to raise in a blind pool fund, which is what we sponsor. But we're buying deals, let's say from $5 to $20 million. They're smaller. Sometimes you got to move very quickly. The fund vehicle was a lot more intriguing to me. I wanted that autonomy, that ability to move quickly, to be creative. And this vehicle allows for that versus the syndication model. I wouldn't say one's right or wrong, just with my circumstances around these property types, with the size and my strategy and just my personality, this worked better for me.
Talk to me a little about that. And the syndication, for the listener, if you're newer to, it's one asset that you raise money into and you go and deploy.
Yes.
But what you're talking about here with the fund, and I always found it really cool, you're talking about blind pool. It's that you have a thesis. You have a way of, hey, this fund is going to invest in this asset classes and with some guardrails, right?
Sure.
And you have to raise the money first. But the advantage that you have when you come to the table to the sellers is other people, if they were to syndicate, they have to sign the purchase and sell agreement, the PSA, lock it down, and then go raise the money.
Yes.
But instead, if you've raised the money first, you can go and say, hey, mom pop shop, we already have this money. We're ready to move forward. So that's a differentiator. But you were
100%.
talking about how it aligns with your strategy, with your personality. And I'm sure that talks about the thesis or the culture of the company as well. Can you expand on that?
Yeah, I mean, I like the creativity around the investment process. Not that you can't get creative in a syndication type of arrangement, but there's something, I guess, compelling. I think you highlighted some of it. You're in a position of power when you're in front of a seller and you don't have to go out there, and you already have the money. You don't even need debt financing. So we're sitting across the table from the seller. I'm ready to write a check today. Yes, I've got to do my due diligence. Yes, we've got to do title, environmental, all that good stuff. But unless the seller is telling me something that's not genuine, we're going to close on this deal. That gives them certainty of execution. I feel we could win way more deals than we could if we resorted or were relegated to the syndication model. And I think that serves our strategy, our brand, and my personality better.
Got it. That makes a lot of sense. I understand more now. One of the things you talked about here, I think you touched on as well, is that idea of vertical integration. And what I want to do is weave this topic into the next one too, which is going to be about culture. You spoke about this as one of your key responsibilities as well. But let's talk about what vertical integration means here and how it really is. I don't want to overuse this word, but we'll say an asset, right? To really provide those returns to the investor, have more certainty of doing right by the people that live there and the community as well.
Yeah, I think that the easiest way to summarize it, and I always say this, not to be cliche about it, but it's control our own destiny. By having this vertical integration, we're not putting our returns and we're not putting our future in somebody else's hands. We've got trust issues here, and we think that nobody could do it better than us. So we want to control that process. And the other thing is, our other mantra here, Steven, is think like an owner. For our investors, I think it would be a disservice for them, for me to go out to them and say, hey, invest in what I'm doing, and then go out to some third party who's just clipping a fee. Right. And basically putting our destiny and our returns and our anticipation for the future in their hands. I think that wouldn't be fair for our investors. I want to control that process. And these are hard assets to manage. This is a lot of grinding, a lot of legwork, a lot of systems, and we built them over 20 years, and we put in the hard work. We're bringing in homes to these. Managing a mobile home community is very different than managing apartments. You're bringing in new homes, you're setting up pads, you're setting up utilities, infrastructure, you're selling those homes. You have to have efficiencies and competencies in all these different areas. You've got to have on-site people that deal with the residents. You've got to build relationships with the residents as well, and make them feel welcome, make them feel at home, because they'll give you referrals as a result of that. And believe me, I've tried to outsource this in the beginning of my career, and I have had a horrible experience with it.
Yeah, I was going to ask that if you had gotten burned in the past.
Yes.
And because this is probably something that many people learn. I know when I was learning multifamily, it was the same thing, like, go find these trusted people. But to your point of getting burned, you're like, nope, we are now doing this, right?
That's exactly what happened. And again, nobody's going to care about the property like the owner. And I think it comes back to the culture. I invest a lot of my money personally as a limited partner in my funds. I don't get any preferential treatment. I don't get special shares. My investment would be no different than yours or anyone else's, for that matter. I do it because I want an alignment of interest with my partners. And I do it, frankly, Steven, for selfish reasons. I don't know where I could get a better risk-adjusted return than what we're doing on a daily basis. So with that alignment of interest, with that think like an owner, and with that kind of control the value add process from A to Z, it's really allowed us to deliver outsized returns historically, and it will allow us to outperform in the future.
What does culture mean to you?
We always say culture is sacrosanct here. I mean, it kind of means everything. If you don't have the right culture, if you have a toxic culture, let's just say you have the best strategy in the world. You found the perfect asset class. You had the cheapest capital out there, but you had a toxic culture. You hated working with the people you work with on a daily basis. You didn't jive. There was no harmony, no camaraderie. You hated life. You made a lot of money, but you hated what you do, and you hated being around the people you were with on a daily basis. It kind of defeats the whole purpose. For us, the culture, the reason why it means everything, when you show up and you're with like-minded people that build you up and you build them up, it not only pushes you to be a better business person, a better investor, it pushes you to be a better person at the end of the day. You enjoy what you do. When you show up happy, you're going to give your all. You're going to be passionate. You're going to be lit up by the process. You can't wait to show up the next day. That's what the culture that we've built Here, it breeds more of those like-minded people and it breeds success. So culture is everything.
I agree. And I'm wondering a layer deeper there. That absolutely makes sense. I'm thinking of this is the things you say. This is the way you behave. This is the way that the people measure each other on how they do things. And also another one that I thought was important is it's the allowance and almost the not provoking, but like encouraged to we're on the same team and maybe I don't do something that is to standard and you're like, Steven, dude, that's not cool. That's not what we do. Right. And
That's
so
right.
that's the first principles aspect, like nuts and bolts of culture, right?
Well, we call that radical transparency. Those conversations are difficult to have, but they have to be had because otherwise that is toxic to the culture. When you harbor resentment in any relationship, your relationship with your spouse, with your kids,
Yes.
with your best friend, if they're doing something that's rubbing you the wrong way and you're not communicating that, you're just going to build these resentments up and then eventually you're going to explode. It's the same thing in business. You got to be honest with one another. And sometimes that's a tough conversation. Maybe you're not going to be best friends in that moment, but in the long run, and people have told me about the way I've rubbed them the wrong way. And in that moment, you think like, oh, how dare you, this, that. And then a week goes by, 2 weeks goes by, a month goes by, and you say, and you reflect and think, you know what, they were right. And I'm going to change as a result of it. I'm going to become better as a result of it. And that's all part of the culture.
Yeah. Do you guys have any leadership principles or have core values, principles like that internally to Crystal View Capital where this is a thing? I know you have a lot of team members and I would imagine
Yeah.
when I think of the Jeff Bezos and Musk, as crazy as he can be in some things, et cetera, but leaders are there to, just like you said, be chief culture officer as well. And some companies will have just things on the wall that's kind of like, yeah, they're written, but they're not really part of
We
the
don't
day to
follow them.
day.
Yeah.
Right.
Yeah. For us, it's transparency, it's accountability. We hold each
Mhm.
other accountable. And ultimately, it's excellence. We show up every day and give it our all. This is not a culture for mediocrity. This is not a place where somebody's going to go hide out and bark orders at somebody that's below them to have them do their job for them and take credit for it. That stuff doesn't fly, and those people don't last here. And that's what I mean by we protect that culture as our key asset here at Crystal View, because you want people that show up. You got to lead from the trenches. My father was in the restaurant business, and I remember as a kid, I was a dishwasher, I was in the kitchen, but you know what? There was no job that was beneath him. He'd walk in, he owned the restaurant. If there was something fell on the floor, there was this, there was that, you had to plunge the toilet, he would do anything. And that's the same, whatever it takes to succeed. There's no ego. We're in this to win together. The only way I know how to lead people and inspire people is you do it from the trenches with them. You got to lead from within the battlefield. You can't be in your cushy office or on the beach sipping a margarita telling people what to do. They're never going to respect you. You
Yeah,
got to be in it with them. And
it's very true.
that's the only way to do it. Speaking of Elon Musk, that's how he pulled off what he did. I mean, he slept on the floor. He was there. I mean, I know he's eccentric. I
Yep.
know maybe he's not the easiest person to work with, but he demanded excellence.
Exactly.
And he didn't demand any less than what he was willing to give, too.
Yes. That is very admirable. Absolutely. Yeah, I very much agree with that. Speaking of this, there's your opinions, your beliefs, just the way you do things gets hardened over time, right? And being in real estate for a while and spotting opportunities, acting on them. We just talked about one of those two, like not the syndication thing. I want to play the game bigger. I see the strategies. I see what aligns to me and I see how I want to form things. Your beliefs about investing has changed a lot over time for you too, starting from the, hey, why don't you just buy my property?
Yeah.
You know, what are some of the beliefs that you've had over time that you broke through? If you can remember any of these, because beliefs are weird this way. It's like, I don't even remember what I used to think anymore, but maybe some of those over time. So people are listening, then maybe they think about an old beliefs and you've had conversations with investors, or you can borrow on that for this answer too. Just what do you see from people that kind of cap them that where they are that kind of helps them to move on to the next thing?
Yeah, one comes to mind right away. I could tell you, and I'll use an analogy from somebody that I deeply admire and respect, was Warren Buffett. And in the beginning of his career, being the world's greatest investor, I think, period. But nonetheless, at the beginning of his career, he was more of a technical investor. So what he would do is he would find cheap statistical bargains based off their earnings and based off their book value and based off the balance sheet where they were trading in the marketplace. And he had a term for that. He called them cigar butts. And the reason why he called them cigar butts is he'd say, you're walking down the street, you look down, there's a cigar butt, it's soggy, it's disgusting, but you know what? There's one free puff left in it. And that's was his investing strategy. And then later in his career, he started buying the Coca-Colas of the world, the Apples, these iconic brands. And he realized there was real value to buying a brand and a franchise, but you had to pay up for them. Yeah. This kind of cheap bargain hunting mentality wasn't going to get you scale. It wasn't going to get you these brands. And that's the same kind of transformational process that I went through as an investor. And those are the same mistakes I made. And I still make them. Like at my core, I want to buy cigar butts because that's how I built my career. I bought cheap parks. I bought cheap storages. I turned them around. They were really hard to operate and manage, but it was almost like impossible to lose on them. But it's not scalable and it's a lot of hard work. And the returns aren't there like when you're buying super high quality, but you got to pay up for that high quality. So I had to make this kind of paradigm shift in my mind and my investment philosophy, not to overpay. I mean, you got to be conscious of the fundamentals and you got to get the best buy you can. But it was difficult for me, and I'm slowly making that evolution to buying the great value within the marketplace. So for us, it's those 3.5, 4 or 5-star communities that are institutional quality, and I'm paying up for them, but I'm still justifying those returns. Yeah. And that's the place that I'm moving into within our funds. And as we move forward and launch our Fund 5 and beyond, that's what we want to build it around, are those institutional, high-quality assets moving away from the cigar butts of the world, if you will.
Yeah, I appreciate that. I think I haven't heard that one, but from a more general principle idea, it's have liked to integrate more and more stories because I don't remember where I heard this from. Have a lesson without a story, never have a story without a lesson. And that we were talking about with the cigar butts and then paying the premium is a fun one because the listeners will remember. And obviously you have, so I appreciate you sharing that.
100%. And here's the beauty. When you buy quality, here's the other problem. When you buy quality assets, this is the other thing Warren Buffett said, his favorite holding period is forever. When you buy something that is a cigar butt, it's got a life cycle and it's going to disintegrate. You have to sell it and then you have to start back over again. Whether you're investing in real estate, whether you're investing in companies, whether you're investing in public equities, if you could buy those iconic brands that have a real moat, they're going to just grind cash flow out for the future in perpetuity. You want to latch onto those and never let go.
Yeah. You've talked about this, and I'm glad you brought the next fund as well, because I heard you say something to the effect of one of the mistakes you've made in the past, air quotes, tongue in cheek, is selling your assets, right? But this is the nature of the investment vehicle. With private equity funds, you have to spend the money, do the value add, and of course, investors expect returns, and part of that might be the exit too here, right?
Yeah.
It's a two for a question, which is that idea of buying assets and holding them forever, are you combining that? Is the idea of the new fund doing that so that it's open-ended as well as just staying in manufactured homes as well? Because the second part of this question is you're talking about going from self-storage mobile home parks, but also moving forward, you're niching down into just these manufactured mobile home park communities.
Yeah. To answer your first question, the answer to that is yes. We want a more open-ended fund, a more legacy fund that's, I'm not going to say it's going to go on forever, but think about it like a 20-year plus vehicle where it's just going to be these institutional quality manufactured housing communities that we're going to buy and we're going to hold for the long term. Because the beauty of this property type, when you could basically go in there, you could keep up with inflation in terms of your rents. If you have any kind of if you have any kind of vacancy, you could fill those vacant sites. And when you have, let's say you have 400 sites and you're going up $30 a month next year, think about what that's going to do. That's another $12,000 per month. And that's $144,000 per year. You put a 5 cap on that.
Yep.
You're close to $3 million, and you hardly rolled out of bed and did anything on
Right.
that deal. Those, when you have a portfolio filled with those and they're super high quality and you have no turnover, and you don't even have to be egregious in terms of your rate increases, your cash flow is just going to compound and grow and grow. You stack that with great management that's conscious of costs. You stack that with the ability to fill vacant sites, and you've got a compounding machine. It may not look sexy year one. The law of compounding, year 1 to year 5 to year 10 to year 15 to 20, it's staggering what you could deliver and what you could build. And that's what Fund 5 is going to be for us. So we're really excited about it. And a lot of our investors are. And the thing about it that's interesting is they'll be able to sell their units within that particular vehicle. And for us, we don't have to sell out of the assets. Like you had asked me, that's the problem with private equity, is that day comes, even when you have a fantastic exit. Almost everything I've sold, I look back and kick myself, but I've had to. And you have a traditional drawdown fund, your investors are expecting liquidity. You have to sell those assets. You leave a ton of money on the table, but that's the nature of the business.
Yeah, it is. How much have you talked about a mentor of yours? And this is like, I don't know how many stories ago in this conversation. A mentor had mentioned some stuff to you. I'm wondering, did these mentors come from, was it masterminds or groups that you were in over the years to learn? I mean, you didn't just read a book and think about launching funds. Of course, you work with professionals and there's power of groups, et cetera. And so coming back to that question is, have you gone into multiple groups and masterminds over the years, and have they served you?
Yeah, I mean, I think it's, if you read Think and Grow Rich, the mastermind principle, you want to be around like-minded people. I think that enthusiasm is contagious, right?
Absolutely.
And if we're both fired up about something, we're passionate about something, we get in a room, magic happens, great
Yep.
ideas flow back and forth. And it doesn't have to be a formal group. I mean, it could just be a group of people that you think along the same wavelength. Surround yourself with those people as much as possible. I did that formally and informally. I'm part of a group today called Tiger 21. It's a mastermind group for investors that I'm a part of. I really appreciate that partnership. I've learned a lot from people within that group. I was part of a group years ago. It was Scott Shield. Maybe that was the individual you were talking about. He had like a real estate mastermind group, and that was really game changing for me in my career and how I underwrote deals and learned about the value add process. That was 15, 20 years ago. Great books. I mean, some mentors of mine are Sam Zell. He was the pioneer of the manufactured housing property type. Warren Buffett, believe it or not, I modeled my funds around his first partnerships, modeled his fee structure, the way he treated his partners, like real partners at the end of the day.
Yeah.
And wanted to build that brand and that reputation the way that he did. Obviously, not comparing myself to him from a returns perspective, but at least how you would treat your partners, how they deserve to be treated. That goes a really long way, especially if you want to continually raise capital. People don't forget that. So I've been fortunate to meet some people that have really helped me, take me under their wing. It's amazing. And at the right time, you got to pay it forward. You and I have to do that with people that from a younger generation and take the time to mentor them and help them. And because somebody did that for us, and we owe it in the future.
Yeah. Well, I think that falls in line perfectly with that idea of kind of own it as well, right? Just not only we didn't really get to talk about this part, maybe you touched on it, but even with these funds, things like co-invest, right? You put your money in here, but you encourage your team to put the money into the funds as well so that they can have that idea of own it, but also own it in the sense of the communities or these relationships to pay it forward, whatever it is. It's, we want to call us control freaks. Sure. We want to be owners of our lives, right?
We want to control our own destiny.
Yes. So, Matt, I appreciate you having you on, man. These 40 minutes or so go by way too fast. Talk to us where we can find more about you, the team, any of the investments, and just follow you along on your journey.
Yeah, visit us at www.crystalviewcapital.com. Feel free to reach out to our investor relations team at invest@crystalviewcapital.com, and happy to be a resource for anybody who's aspiring to be a real estate investor. And if what we're doing sounds interesting to you and you want to have a conversation with someone on our team about returns, past performance, how to make an investment, please reach out. We'd be thrilled to speak with you.
Outstanding. All those will be in the show notes. Go check out Matt and his team. Matt, thanks for being here, my friend. Appreciate you.
Thank you, Steven. Appreciate your time.
Cheers.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in the future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.